Hi everybody, my name is Dennis and welcome to the first video in a series about writing your own algorithmic trading bots in Python to trade cryptocurrencies. So I'm going to keep it simple in this first video and explain to you what it means to be long, to be out of the market, and to be short. So here is a bot that I wrote in Python that trades Bitcoin. It trades using daily prices from Binance. But you don't need to worry about that for now. The bot uses something called simple moving average to trade, which is a strategy from the 90s, and it actually still works pretty well. So let's run the bot and see how it did. Before we get too deep into that plot, let me show you what came out in the terminal here. So during this time period, simply buying and holding, which is labeled returns, had a 0.87 return. So if you bought one Bitcoin at the beginning of this time interval and just held it, you ended up with 0.87 Bitcoin at the end. And using my bot to trade, you'd end up with 1.58. So that's a 1.8 outperformance, which actually sucks, but this is going to make, I chose this bot because it's going to be really easy to explain this. So here we are. At the beginning of this time, the bot was holding. So if you look at this red dashed line, that corresponds to this y-axis on the right, and 1.0 means hold a full 100% of your assets in Bitcoin. And 0 means to get out of the market. So during this time, from here to here, we are buying and holding, which is the same for the bot and for simply buying and holding. But at this point, the bot decides to sell all the Bitcoin and get out of the market. So during that time, the line is flat, which makes sense because it doesn't matter what the price of Bitcoin does, you're just holding dollars. So it turns out it was a good decision. As you can see, Bitcoin went down during this time, and over the days and months, sometimes the bot decides to buy and sometimes the bot decides to get out of the market. Right here we have a run up and had some pretty good performance, and then things get worse over the years. This strategy is not that good, but as you can, the important thing for you to see here is that when you're out of the market, it doesn't matter what the price of Bitcoin does. So that's 1.8. Now let's explore a concept called going short. So I can configure my bot to go short instead of exiting the market with this variable. You can do it too if you download and run this code. So let's run the bot. Let's look at the terminal. And you can see, obviously, buy and hold is the same as before, but now the bot is quite a bit stronger. Now we have 3.3x returns. So let's take a look at this plot. So it's the same as before in terms of what it means to be long, but now instead of getting out of the market, the bot goes completely short, so -1. And what it means to go short is that you're betting the price is going to go down of the asset you're shorting. And the way this works is you borrow the asset when you go short, and then you sell it, and you have a negative balance of the asset, in this case Bitcoin, and when you decide to stop going short, you go and buy the amount that you sold before, and then return it to the party that you borrowed it from. And exchanges like Binance allow you to do this automatically. So if you borrow something, like if you borrow a Bitcoin for $12,000 and you sell it, and then the price goes down to $10,000, then when you buy that Bitcoin to return it to the person you borrowed it from, you only had to pay $10,000, so you made a profit of $2,000. Now, obviously, if the price of the asset goes up while you're shorting it, then you lose money. And since there's no limit to how high the price of an asset can go, shorting can be dangerous, and you could cause your account to be liquidated on an exchange if you go short, because if you can't cover that short, the exchange will just liquidate your account and all the money you have on there will be gone. But as you can see, a strategy that uses shorting outperforms strategies that don't use shorting, because if you think the price is going to go down, you want to be short. So to illustrate, let's look at the chart. Here's the point where the strategy used to be flat, but now, because we're shorting, it goes up when Bitcoin goes down. So this is a pretty simplistic example because we go completely 100% in the market, 100% out of the market. Real trading bots are more sophisticated, although simple strategies work best. But that's basically it. That's what it means to be long, out of the market, and short. And in a future video, I will explain whatever you guys want to know. I can walk you through what these simple strategies look like and what more realistic modern strategies look like. Looking forward to it. Please let me know in the comments what you want to know about writing trading bots, and check this out on GitHub and run it yourself. Thanks a lot. Good luck. Have fun.